Hey, my name's James Nicholson. Welcome to my YouTube channel. Now, in this video, we're going to talk about where are the Bank of England going to move the interest rate to next week on February the 2nd. Now, it's been a turbulent year, hasn't it, financially for a lot of people. Now, we started 2022 with the property prices just kept going up at that stage. But what was really impacting a lot of people's pockets was inflation. And that peaked at over 11%. Now, we've still got really high inflation. I think we've just dropped down to 10.3%. I mean, it's 10 point something. It doesn't really make much difference, does it? Whether it's 10.6, 10.8, it's still above 10%. Now, that inflation is causing hardship and unpredictability for business owners and consumers alike. And so the Bank of England has got to act to bring that inflation down. Now, what's happened is inflation has peaked. It is coming down, but it's not coming down very, very fast. Now, there are indicators that are showing that there are some positive situations happening. There are, for example, cars that are on sale, because what happened with the pandemic was that supply chains just got absolutely smashed, and so you couldn't get products. And so things like the used car market went absolutely through the roof. I sold an Audi in that time. I'd had it for 3 years. I sold it for exactly the same price that I bought it for, which is not common that you would normally do that. Now, supply chains have caught up. And so now big businesses are stuck potentially with a lot of stock going into a recession. So Tesla's already acted on that. They've already knocked off about 15% off the price of a brand new Tesla. And so that's going to help with inflation for people that are into buying a new car. Now, food is the big problem that we've got at the moment. And hopefully energy prices are going to start coming down, which will help with the cost of food, because there's so much energy that's used in order to manufacture the food that we eat. Now, another thing was the money printing, wasn't it? So when the pandemic was happening, the government just turned on the money printer and businesses were able to get bounce back loans. There was the furlough scheme, and all of these things had a big, big, big impact on us as consumers. And so that caused this really, really high inflation, not seen since the 70s. Now, the good news is if you go and look at the future price of gas and electric, that's expected to drop big time in the summer. And that will feed into way lower inflation, which is a positive thing. So that's going to be really, really good for us as property investors, particularly those that run something like an HMO or something like that. Also, if you don't run an HMO and you're just a normal buy-to-let, it's good that your tenants get a bit more cash in their pocket, because that means they can afford to pay you rent, which is very, very important. Now, another thing that has been hit by inflation and landlords leaving the sector is rent. And so rent has had some record rises in the last few months, or even the last year. And 20 to 30% of landlords actually quit the market due to these interest rate rises, due to Section 24 and various other things. And so all of this coupled meant that right now we're sitting on an interest rate, a base rate of 3.5%. Now, I've had a look, I've been reading a lot of articles over the weekend on where do we expect the rates to go next week. Now, the consensus is that we will get a 0.5% interest rate rise, because we're still right up here. Although we're on the way down with inflation, it's not coming down fast enough, and the Bank of England wants that to happen. So we're looking at a 4% base rate potentially next week, up from 3.5%. Now, does that impact homeowners and property investors? Well, what would normally happen if you were on the variable rate, your rate is going to go up pretty quickly. And in 2008, when we had the last big property crash, a lot of us were on variable rates, and that caused a lot of hardship for a lot of people. Now, more often, people fix their rate. So if you're on a fixed rate, this isn't going to impact you right now. When it will impact you is when you potentially go to remortgage. Now, mortgage companies have already, a lot of them, baked in these rate rises already. So since the last rate rise, some rates that you actually pay, the bank that they lend you money at, the rate that they lend you money at, has actually dropped. So the rates went up, but the borrowing rate that you get actually dropped. And that's because a lot of the mortgage companies panicked when Liz Truss was in power and already put some of these interest rate rises into their products. And so I don't think that you're gonna see a lot of deals changing massively in the next few weeks. So if the rate goes up to 4%, which it will, and we were expected, when Liz Truss was in charge, we were expected to the base rate, the Bank of England rate, we borrow at a higher rate than that, guys. So whatever the base rate is, that's what the banks get the money at, and then they put their margin on top, which is normally at least 2%. So if it's 4%, you're looking at a 6% rate, right? Now, when Liz Truss was in charge, they were expecting the base rate to go to 6.5%. That was then revised down when Rishi Sunak took over to 4.5%. And what it's looking like now is more likely we're going to peak out at the 4.25% rise. So what might happen is we'll go to 4% in next the 2nd of February, and then I think that the next rate rise might not happen as quickly. I think they might just want to see what's going on with this inflation. If we start dropping to 8% inflation, then maybe they'll see that what they've done is working and pause the rate rises. If you read about what's happening in America at the moment, a lot of people are expecting that the Federal Reserve, so that's the equivalent of the Bank of England in America, they're the ones that set the rates for the Americans. A lot of people that are expecting that the Federal Reserve is going to pivot soon. Now, they can't tell you that. They can't tell you that they're going to start cutting rates, because if they do that, it won't have any impact on what they're doing right now, right? They've got to keep it quiet, and then at some point they will announce that. But looking at a lot of the data coming out of America, a lot of people are expecting that by the summer that the Federal Reserve will stop dropping rates. They think they've gone a bit too fast with these rate rises, and potentially the Bank of England has done the same. So what will happen is the rate rises will help drop the inflation, but then we're more likely to officially go into a recession. How do you get out of a recession and stimulate growth? You cut rates. Now, I think that what the Bank of England are going to do is actually just slow this process down. So I think that you will get more rate rises, but I think that you will get some months where nothing happens, where we just have a wait and see approach. But what do you think about this? Do you think this is going to impact you as a property investor or a homeowner? Do you think if on the 2nd they put the rates up to 4%, do you think the deals are going to change in the market, or do you think those are already priced in, those interest rate rises? Do comment below. I'd love to know your thoughts on this. Do subscribe and hit the bell on this channel, guys. We're constantly growing this channel. We're on the way to 5,000 subscribers. We're nearly at 4,000 now, and we're at 50,000 monthly views, and we're trying to get this up to 100,000 views as quickly as we can. So do subscribe, like the video, comment below with your opinions. Check out all the other content on my channel, including this video right here. Bye for now.